Perfect. And now over to you, David.
Thanks, Zulema, and welcome all agents of impact. If you have been on these calls before, you know that now is the time to start introducing yourself on the chat. And since it's a Muni impact call, tell us what Muni you're most familiar with, or where you are right now. There is a ton of talent on this call, so the chat function is the best way to connect with each other. Let's jump right in. I want to bring my colleague Dennis Price, who many of you know, ImpactAlpha's Chief Impact Officer. Dennis.
Hi, everyone. Welcome. Thank you for joining us and look forward to a great conversation.
We are also super excited that we have been with the sort of series of posts leading up to this call, kicking off our Muni Impact project with the support of the Robert Wood Johnson Foundation and Kimberlee Cornett. Welcome, Kimberlee.
Thank you. Nice to see you.
It's been terrific working with you and the team on this. We've learned a lot more about muni bonds than we knew a few months ago. So thanks for the opportunity.
A pleasure. And I think any of us who have retirement assets, you probably already owned a muni, but maybe didn't know as much about it as perhaps you do today. I think some of our agent of impact colleagues have called the municipal market kind of the original impact investment. We believe that that's true, and are really delighted for the reporting that your team is kind of bringing to this sector and thinking about how impact really, runs through the heart of it.
And racial equity, and then in the RWJ context, health equity as well.
Yeah, thanks. So the Robert Wood Johnson Foundation, as some of your listeners may know, is the largest foundation in America focused exclusively on health equity. But over the last couple of years, I think has done a deep investigation of what it really means for America to achieve that. And has really, I think, come to the conclusion that getting to racial equity is a precursor to health and wellness for all. And although RWJ has been around for 50 years, this is our 50th anniversary, we're a relatively new impact investor. And so when my team arrived in the heart of the pandemic, we really started looking around for where there were big pools of capital that were not fully optimized for health equity and racial equity. And the municipal finance market really jumped off the page, and we were delighted to know Lourdes Germán from prior work and sought her counsel as to how we could start to really set the table for a variety of partners to investigate this.
Terrific. Well, that's a perfect segue. Let's bring in all our guests. Lourdes, you've just been queued up by Kimberlee. Lourdes Germán from the Public Finance Institute. Welcome.
Great, and thank you for having me. My name is Lourdes. I've spent about 20 years in municipal bond markets, specifically focusing on many different hats for issuers, even before examining the current body of work that we're going to talk about today with a race-conscious lens as bond counsel, underwriters counsel, then as an investment banker, and working within a large separate account manager that often invested in munis every single day. And then transitioned my career to working in the foundation space in higher education, where I got the privilege of looking at these issues from a different lens, more holistically and globally, and thinking of the intersection of municipal finance with equity, sustainability, inclusive growth, and so many other values that I'm sure will come into our conversation. I'm really pleased to be here.
Terrific. And Tim Martin, for the Assistant Comptroller for Public Finance in New York City. Welcome, Tim.
Good morning, all. My name is Tim Martin, Assistant Controller for Public Finance. I've been involved in municipal finance my whole career, starting at a boutique financial advisory firm, which provided financial advisory services for primarily water and sewer issuers, but also a variety of other issuers all around the country. And then since 2011, I've been involved, I've been employed by the City Controller's Office, where we, along with the Mayor's Office, jointly roll out the city's capital program, the investing portion of that, where we raise anywhere from $10 to $15 billion a year across multiple credits to fund the city's capital program. As you can imagine, is quite large. And so I'll be talking a little bit later about some of how that works a little bit, and then specifically our the city's first social bond that we priced in October, which we're really proud about the impact of that.
Terrific. We're gonna dig deeply into that one. So thank you, Ed. But let's say hello to Tim Fernandez from Breckinridge. Hi, Tim.
Oh, hi. Actually, it's
Rob.
Rob.
Sorry, I'm sorry.
That's all right.
I have your colleague who I believe is on the
Yeah,
call, Tim
he's
Coffin.
on.
So
Tim
I got my
Coffin.
Breckinridge mixed up. I'm sorry
That's
about
all
that.
right. We work really closely together. He's a great guy. And but yeah, my name is Rob Fernandez. I'm Director of Environmental, Social, and Governance Research at Breckinridge. And I apologize for my voice. I've had a cold the last few days. But yeah, I work on the investment research team at Breckinridge Capital Advisors. We're a high-grade fixed income manager and manage about 41 billion in assets in total. And a good percentage of the assets that we manage are municipal bonds, which we manage for institutional as well as retail clients on a separate account basis. And we've been considering environmental, social, and governance considerations for over 10 years in our process. And so I'm here to provide that perspective. And we also do think about municipal bonds from an impact investment as well. As there's real natural alignment there, as has already been said. So it's great to be here. Thank you.
Terrific. Well, Dennis, why don't you take us and engage Tim on the New York bonds?
Sure. So we wanted to kick off with an example. I mean, New York is one of the largest, if not the largest issuer in the country, has one of the most recent social bonds, the city's first. Tim, can you tell us about it? Tell us about the bond.
Yeah. This was actually, it's funny. This was the culmination of a long policy work that we did dating back to even 2014. When me and my colleagues at the Comptroller's office started to really look at green bonds. It's actually kind of funny. Post that report, we actually visited with the folks at Breckinridge to get smarter in the space, because it was still very new in the municipal world, even though it had been growing a lot in the international. And so we've been exploring it, and finally, again, because we do things jointly with the mayor's office, it took a little bit of time, but it was our first social bond where the city, the proceeds for that were for affordable housing projects to be funded around the city. The city has a large affordable housing program, and we used the proceeds to fund 3 specific programs within that to help alleviate, the burden of costs and reduce poverty among our population. And so it's really important to us to do this, and we were able to carve out this specific series of bonds, and it was really nice to be able to highlight the things that we already do in and around the city. And it was also nice to give ESG investors exactly what they wanted by way of a different structure than what we might normally do in a bond offering, and by enhanced disclosure, really highlighting those projects and the programs that they're going to finance.
You mentioned that this is not, for example, not the first time you used a bond to fund affordable housing. So why go through the trouble of designating this a social bond?
It's a great question. Yeah, it's exactly right. We do a lot of affordable housing. We do a lot of things that would qualify under ESG. But because we issue a lot of bonds every year, we need to look for different ways to engage investors. And while we're sitting here yelling from the rooftops, we're selling these types of bonds, we're selling these types of bonds that you care about. The information that we provide to them is more general in nature in our regular bond disclosure. So we don't just do project finance, which is what a lot of other issuers do. We don't say like, okay, we're going to build a wastewater treatment plant and then issue bonds for it, right? Our bonds, any given bond issue can be financing all or a portion of, hundreds of projects. So even though we say that we're doing it, the ESG investors, what we've learned over the years, they really want to know exactly where those proceeds are going. Ring fencing is the word there. And we knew that we already had the infrastructure internally to give them what they want. So he said, why not go ahead and do it? And quite frankly, the added expense for us was quite modest, given the context of how large our bond issues are. It was, we had to go out. I think the biggest expense was going out and getting a third party or a second party opinion provider, S&P, on this one, to go and do the homework and provide a report to the investors. But that was a very modest expense, less than $20,000. So in the context of $400 million, it was something that we were happy to do. And in the long run, that's going to pay off. But I could even say that in this particular transaction, that more than the additional work that we did, brought in extra demand and allowed us to lower our yields, and it more than paid for itself in this transaction. And then, long term, it brings a whole new set of investors to the city's program. We received, we had 20 investors who never participated in city transactions participate in this transaction. Now, some of them did it for structure. It was a unique structure. It was a longer dated taxable bond that we never did, but 10 of them were strictly for social mandates, ESG investors. And so those are 20 new investors who did the credit work for us and could potentially, participate in regular transactions afterwards. And so we felt that by doing this extra work, it was good for both this transaction, but also long term. It helps us in our future transactions, and it provides us. It also validates, the underlying projects, and that we have a successful investment vehicle for investors to fund projects that are very important to, our constituents in the city.
I just want to pause on the one thing you said, which was that you had so much demand that you were able to lower your cost of capital. I just want people to sort of hear that. You want to give a little more detail on that?
Sure. The offering was $400 million of bonds. We received in total $1.8 billion of bonds. So we're a little over 4 times subscribed to that. Of that 1.8, 400 to 450 million were confirmed investors with an ESG mandate. And we received confirmation that they would not have been able to, because of their mandates and what they do, they would not have been able to participate in our transaction had it not been, had we not gone through the process to certify as an ESG bond. So that's $400 million is a big deal. And that one extra time of subscription allowed us to lower our yields. We probably would have been able to, would we have been able to lower our yields with 1.4 times, $1.4 billion? Sure. But I think we got a little extra pricing power of the 1.8 times. And throughout the entire process, we were able to, demonstrably tighten our spreads to treasuries than what we probably otherwise would have been able to do.
So saved the city. Can you say like how much it saved the city?
Oh, I'd say, I could probably confidently estimate 2 to 3 basis points. It wasn't 5, but it wasn't 1. So it's probably somewhere in between there. And that's a lot, that's a fairly significant amount. Also, what was interesting too, we actually did have an ESG investor drop their order on the reprice, which was actually pretty interesting to us. So, I think people have said maybe, ESG, but that's not always the case there. At the end of the day, these investors, we learned, are fiduciaries, and they're not going to just they're not going to really go in and say, hey, we will really pay up for this. But the one, they are willing to, maybe, accept some lower yields because the market demand is there. And but they won't specifically go in and say we will pay you an extra 5 basis points. They are subject to the market as well. So it's a pretty interesting process throughout.
Last question, at least from me, was you said there's additional reporting on the impact, and you know, how does that play out? Like, are you able to really show social outcomes in some way, or what do you actually have to report?
This one in particular, we're not doing impact reporting. We said up front that we're spending $400 on these specific projects. Okay, we listed those projects in the US, and because of the way that the city finances, where we pay out of the general fund first and then reimbursed almost immediately with the bond proceeds, we can rest assured that what we said the proceeds were going to does in fact. And then the impact, I guess, is, the proof is in the pudding there. We're providing affordable housing to people. I'm just looking here at the Ella, one of the programs here, the Ella program, extremely low and low income affordability. 18% of the units that are being built are for folks who were formerly homeless. 17% are for AMIs up to 30%, 67% are for AMIs up to 60%, and 96% are for AMIs up to 80%. So you can see the impact almost immediately. These in the housing space, these apartments are going to go to folks who are, quite a bit below area median income. And it's going to provide affordability for a lot of residents in various parts of the city there.
Terrific. Thank you so much, Kimberlee. This is the kind of stuff you wanted to dig into here. So why don't you sort of say, put this in a little context for us of how New York fits into all the other work you guys have been doing.
Well, I'm delighted that Tim was able to join us. Because we're still learning a lot from the field in this process, and New York has certainly given a fine example to the field. Before I offer a few remarks, I just wanted to give a shout out to my former colleague and somebody that I admire, Napoleon Wallace, who I saw is here in the chat. I would say that, my interest in the municipal market really finds its roots into some very excellent thinking that Napoleon had done many years ago, that after work, we would spend time thinking about. And so he really planted those seeds for me a number of years ago, and has continued to kind of just really push the field into how it thinks about the municipal market and the intersections with race and equity. So Napoleon, continue to invite you to chat in the chat, because I know you'll have something to say here. So as I mentioned at the top, the foundation really has been looking at, where there are large veins of capital not fully optimized for health and racial equity. And so really, I think, sometimes the best work that we're doing as investors within philanthropy is really setting the table for the experts to come together. And that was really our first move, was really to bring together an advisory board with a lot of leadership from Lourdes, and see if we were, headed in the right direction. And I think, much to our, surprise, even more than we were hoping for, at that moment, I think we were really tapping into an issue that many people around the sector were already thinking about, but perhaps didn't have a place where they were really coming together. So a shout out to Rob, to Mark Kim. Activist has been certainly a part of the equation. At Asenia Social Capital, we really kind of sought the advice of practitioners who were really in the field, thinking about both kind of how to move the field closer to equity and what investors really were looking to know about that. And with the leadership of Lourdes and guided by our advisory board, really the work has been about developing this framework that's really informed by issuers, but provides a tool for communities that are hoping to go to the market to really unpack both kind of their aspirations for the capital, as well as kind of how they will report back in disclosures. And I think Lourdes is going to go into a fair amount of detail about that. That framework has been informed by over 100 interviews with issuers and other experts. So we really wanted to make sure that, we didn't craft something that was kind of created in a bubble, if you will, but was really informed by the folks that, have to get up every single day and do this work. Our long-term aspiration is really to think about how we partner with issuers, both in terms of kind of capacity and research, but perhaps, really assisting communities in getting to the market where there is deep intentionality around really just disproving, that there is some correlation, which we know to be not true, between race and risk. There is a really important book, The Bonds of Inequality, written by a professor at Stanford, who really talks very passionately that growth has not been an equal opportunity for every community. And many communities have faced very explicit barriers that have prevented that growth. And so our long-term aspiration is really to think about how do we help those communities, both through kind of research and technical assistance and access to the capital markets, to find the capital that they really need to get on a more equitable path to development.
Kimberlee, it's from what I'm learning personally, just poking around and interviewing folks, it's a very, I think by design, risk-averse asset class. And so when you're thinking about shaping the market and optimizing the market, what are the levers you're looking at in terms of what you can pull and where you can support folks that have influence or otherwise shape the market?
So some of it is by way of example of what, folks like New York are already doing, about how they really kind of lead with a very explicit social goal and very explicit outcomes that investors can rely on. We know that there is huge demand out in the market for these kind of issuances. But, New York is a gazelle, certainly, and there's a lot of communities that are kind of earlier on in their learning journey with how they can do that. And I think Lourdes's framework and the draft report that we're going to be putting out and looking for feedback on is really about how do communities of all sizes and shapes and geographies, how do they make steps forward? So I think one is through research, and two, through a relationship that we have formed with PFM, really supporting communities with technical assistance and expertise as they really think about forming their issuance. And then finally, RWJ, like some of our peers, but with a different intention, has a rated guarantee product. And so we're really trying to think about, is there a role for some sort of guarantee in this market that, helps to kind of catapult communities forward? Another thing that we're looking at is bond banks, which have been a tool that have certain states have used to aggregate issuances from smaller issuers in order, again, to create access to that market. So, we're still very early on in this work, but it will be kind of a combination of kind of research, technical assistance, listening to the experts, and then thinking about what the investment options are that are appropriate for the foundation and are going to be impactful out in the market.
Fantastic. And stick around as we continue the conversation, but I wanted to bring in Lourdes Germán of the Public Finance Initiative. Lourdes, we've been dropping your name and your work numerous times so far on the call. So let's dig in. I mean, you've been convening lots of folks, lots of stakeholders who is involved here in this market. Just give us an idea of who those stakeholders are.
Great, and thank you for this invitation. I think Kimberlee did a fantastic job, even kind of hitting the nail on the head on a lot of the stakeholders that you'll be hearing, we are working with and looking forward to really introducing what I'm calling a paradigm shift that we're witnessing in municipal bond markets at this really exciting juncture in time. But to answer your question, when we started this project several years back, and even in January with the official launch, we actually began by listening. So we brought together a number of issuers from across the country, over 100 from 34 states, in partnership with the National League of Cities and several other collaborators. And our first ask of them was not to tell them what we wanted to do, but actually to say, what do you need? How are you experiencing municipal bond markets? What brings you to the table around a racial equity-centered conversation? Do you see gaps? Do you see knowledge needs? Do you see the opportunity for strengthening your practices? And what we learned was remarkable in several regards, particularly from that channel where we met small to mid-sized cities who were eager to participate but face real challenges, including something that we know is a challenge of a small issuer in a market where everyone is not at the half-thin market recognition of New York, and large issuers who also recognize the market power that they already garnered with great economic results, even without the inclusion of racial equity, but saying we want to do it anyways. And these are some of the novel things we are trying that were practices we recognize were flying a little bit under the radar. And that was probably one of the biggest aha moments of this process, particularly from the National League of Cities Focused Learning Channel, is really understanding that there is an incredibly wide spectrum of practices that we are not focusing on, because traditionally when the market looks at a deal, 97% of the time we're looking at the use of proceeds. We're saying, and rightly so, what is the project funding? What is being funded by the bonds? What's been authorized? And one of the top learnings that we came away with is that that's not the only question to ask. There are many communities, particularly small to mid-sized cities, who are doing really innovative things with the investment earnings from their bonds. There are programmatic decisions that are including under what we would otherwise think are environmental issuances only, a race-conscious effort on environmental justice in disadvantaged communities that's happening at the state revolving fund level. As Kimberlee mentioned, we also learned from bond banks who are specifically starting to think about the inclusion of social principles in revolving loan programs. And those are really exciting moments for us, because in a market where there's very little innovation, and where I've seen for 20 years, and as a both professor and a scholar practitioner, it's exciting to see change and to be on the forefront of that. And again, that wasn't our only channel. We also really were intentional about listening to the other participants who we know are vital to the deal, whether because they're gatekeepers or because they sit at the table with the issuer and are the first line to know when the deal is coming, how that deal is going to look when it's presented to the market, including investment banks, underwriters, bond counsel. We also spoke to rating agency leaders from every one of the major rating agencies, some of which started out in our advisory committee. And our partners in that effort included the Milken Institute, Center for Equity and Excellence in Public Finance, and the Initiative for Responsible Investment at Harvard. And we really learned how investors are also thinking about what they will demand and when in order to participate in the deal, the way that they think about cost of capital, and the importance that they place on rigor in reporting metrics, and how they want to see an equity story unfold, particularly one that is centered on racial equity. And in addition, we know that there's a lot of information beyond what we heard from conversations that was vital, because when you think about something as complex as racial equity, it doesn't just exist in a deal in one moment in time. So thanks to the collaboration of one of my colleagues at Harvard, where I teach, Toni Griffin, she and her team with Ideas in Action, Urban American City, canvassed the nation. And they searched not just for how racial equity was showing up and the racial equity propositions that are present when we look at a deal like New York or others, but they went well outside of that and looked at a range of instruments, including RFPs, land policy decisions. They looked at capital investment plans, CIPs. They really ran the gamut, and they looked beyond the issuer, but actually started to look at a broader set of stakeholders, including community members who on their own were raising and elevating what racial equity meant and how it could look in infrastructure-focused decisions. And with them, we were able to develop several resources that you'll see coming forward in the next couple of weeks, including a way that we believe will help the market become more fluent in articulating a racial equity proposition that is clear for an infrastructure project, when often that can be hard, and a set of resources to really start thinking intentionally around measurement to align with those goals. And I'll pause there because I know it's a lot of information. We learned a ton, and I can dig into more.
Lourdes, one question I've had, some of this takes place, at a pretty rarefied level in the markets, but you've had a focus also on actually community involvement in understanding both the proceeds as well as the process. What does that actually mean? How can actual, citizens, as it were, be involved in any of this?
Sure. So often you think there are two meaningful junctures, right? If you think about a bond deal, it's funding a project and you've authorized the debt. And often this happens under the cover of open meeting law. Somebody actually saying we held a public process, and I saw it 20 years ago as bond counsel, and just it's vital to say, the deal has been properly authorized. One thing we were really pleased to uncover is the number of communities who are integrating racial equity conscious community engagement strategies across their fiscal processes generally, across their capital investment process, completely unrelated to the bond market authorization process, and really starting the meaningful conversations where they brought together the community, particularly BIPOC communities, to say, what do you think about this project? How is this going to benefit or feel like a burden when we think about what we're trying to accomplish here? And by surfacing those examples, it's one of the many practice changes that we saw possibly vital and available in the market that we could elevate, including one community, for example, is Chandler, Arizona, which we're going to feature in a report that's going to be it's actually available today, but released tomorrow with the National League of Cities, that summarizes a little bit of what we learned through the strategic conversations that led to the issuer focus group efforts and informed the framework. And they describe specifically how they take a very intentional lens, even years before they authorize a bond, and are just thinking about capital investments in that multi-year process to bring people to the table who should be there when you think about the communities who are most impacted by infrastructure and the way that those investments take form.
I know you're on your way to the National League of Cities Summit, and this report and a bunch of the work you've been working on for a long time is going to come up there. You mentioned Chandler, Arizona. We've seen New York. What are some of the other cities that have exciting projects underway?
So many. We'll reveal some that have already been done. For example, small to mid-sized cities, as I mentioned, struggle to say, how do we participate in a market where we're infrequent and small issuers, but we care about racial equity too. One example that's also featured in the report is a small city, Las Cruces, New Mexico, where they said, we actually look at our bond investment earnings and we take an intentional strategic approach that includes community engagement and a focus on BIPOC communities and other social needs, and think about the allocation of those funds strategically with a racial equity lens. Again, never centering a strategy in the use of proceeds, but actually thinking more broadly about what they can do within their agency. There are communities, for example, like Denver, Colorado, who issued a recent issuance called the Elevate Denver, Rise Denver issuance. We don't see a social label on that deal, right? But when we look under the hood and actually see, well, where did the Elevate and Rise initiative come from? It's grounded and rooted in the city and county of Denver's incredibly strong and sophisticated approach to centering racial equity across their entire fiscal processes. So it's a process that begins well before the bond issuance. And when you look at what they're doing, there's an even stronger story, and they're well positioned for impact measurement, risk reporting, and actually really thinking intentionally about racial equity, not just as a process, but as an outcome in Denver. And I could give you many more examples that are emerging, but one that really stood out to me is often we see this conversation centered around cities. Public authorities, particularly state revolving funds who participate in water sewer issuances and bond banks, as Kimberlee mentioned earlier, they are vital to this conversation. And I can't tell you the number of issuers who joined our focus groups and also where we saw and then deeply investigated their frameworks. And we saw that under what would otherwise be a green deal or a sustainable deal that's not labeled social, there was significant attention being paid to racial equity and particularly disadvantaged communities. And those are the examples that we are incredibly excited to bring forward, because that's a programmatic decision that is vital and at scale, because it's helping smaller communities access and service those infrastructure sectors at a low cost of capital, with racial equity included as a programmatic focus of the borrowing guidelines at scale at the issuer level.
Lourdes, one last question. You mentioned the framework that you'll be releasing for review. Did you want to share maybe at a high level what you learned and what might be in that included?
Sure.
In that?
And I'll credit all of our partners, because this is, again, beyond listening, it was a true collaborative effort that beyond National League of Cities, it included the Government Alliance on Race and Equity, the Urban Institute, and the Milken Institute team, the Initiative for Responsible Investing, Urban American City, and Ideas in Action as our core partners in this work, as well as members of my team who are here today too on this call. But part of what and I credit my colleague David Wood, who I think is on this call, when we joined as partners in June to say, what did we learn from all these channels and what are we seeing? One thing that stood out to me, and which I think David challenged me to think about, is, are we seeing a paradigm shift? Are we seeing a market that for green bonds for 10 years and other markets that include a value centered in ESG, look at the use of proceeds with like a razor sharp lens? But we are seeing a wider set of practices emerging around racial equity. I don't know whether it's indicative of a similar paradigm shift occurring across other designated categories of ESG and impact issuance, but we're seeing it here. And the goal of the framework became really quickly to elevate first those normative practices and to tell issuers, you've told us you need a roadmap, here is your roadmap. We're centering the practices that we think are vital and emerging, including with the ones that are tested, tried and true, including the use of proceeds. And in addition to that, we're going to couple that with learning opportunities, technical assistance, so that we are meeting issuers who have either high readiness, low readiness, and all as many awareness gaps as we encountered. And coupling that with other programmatic efforts that we're going to be talking about later this winter. But then in addition to thinking about the normative practice change that we want to encourage, we also want to elevate the opportunity of the market to see what does it mean to look at a deal under a different lens. Should we be awarding issuers a discount when we see other practices that we are typically not looking for? And then the second part of the framework focuses on creating a racial equity taxonomy to strengthen measurement, saying there's no one size fits all approach, but we want to give you a roadmap and encourage you with resources there to really see deals be better and hopefully outcomes improve from either a risk mitigation standpoint and also impact.
Thank you, Lourdes. You can tell everybody that Lourdes is a wealth of information and also speaks quite quickly. But we will, be mining all those resources, and we'll bring them to you in the brief. So if you didn't catch every detail there, we'll recap. But that's a good segue to Rob, because Lourdes' comment about where in this market transformation are we? Like, what are you seeing in terms of issuers and issues and investor interest in these kind of issues around racial equity, social impact?
Yeah, thank you, David. And yeah, Lourdes made a ton of really great points. What I'll say is that we are definitely seeing demand from institutional investors as well as individuals for impact investment solutions. I mean, we have a number of clients that are with us that we manage money for that appreciate and like the impactful nature of municipal bonds. That is without a doubt. We don't necessarily label ourselves as an impact manager. However, our focus is on ESG integration across all asset classes, municipals, corporates, sovereigns. But there is certainly that impactful nature of municipal bonds, and I'll get to it in a little bit. But if there was additional data available, or more data, or more disclosure from issuers more broadly around environmental, social issues, racial equity issues, then it's likely that we could potentially offer more customized impact solutions for clients. But more specifically to your question, we have also seen interest among current and potential clients for a strategy that would more directly incorporate racial equity metrics into our investment decisions in some facet. There's certainly interest for it. But at this point, it's not something that we can accommodate in a broad manner. And then
it's not something you could accommodate in a broad manner because there's not enough product for that?
There's not enough data. There's not enough disclosure from issuers, either disclosure from issuers about certain racial equity considerations, broadly, or maybe data sets that we can incorporate to build a diversified investment portfolio. And to your question too, David, part of the consideration that we have to think about too is building a diversified portfolio, which we want to do for clients. So that's across sectors in the municipal market. It's cities, water authorities, school districts, higher ed. We're going to have a sprinkling across these different sectors. But then there's also the credit consideration as well. I mean, the key priority for us is producing a reliable stream of income for clients. That's why they're with us. So we want to ensure that we can invest, across sectors and also with strong credit quality in mind.
But if that makes sense. Just dig in on the credit quality. I think Kimberlee referenced the Bonds of Inequality book, and we did a piece last week on bond banks, which were in part an attempt to correct some of these sort of mispriced risks in the market, particularly what people are calling the black tax. that affects, smaller cities with large Black populations. Just how do you see, how the current credit scoring, works or doesn't work?
It's an excellent question. It's one that we've been challenged by over the years when we've considered offering potentially more impactful municipal portfolios for clients, maybe targeting certain geographies or certain areas or small communities versus large. But I think the overall issue, and to your point about bond banks or state revolving funds, there's credit enhancements available in those structures that really do help those communities, and we certainly are active buyers of bonds from those types of structures. I think it's like we have to balance our desire to, just I guess kind of like what I mentioned already, it's balancing our desire and what our clients are looking for is reliable income from what we are offering is a high grade, high quality, high credit quality portfolio with a desire for impact. And we certainly have had clients or potential clients that maybe found that impact in more of a high yield kind of structure or mutual fund structure. But it is an ongoing challenge, and it's one that we think about a lot.
Rob, one more follow-up on the pricing question. You shared some interesting research with me from your it was done by your colleague Erica Small around evidence of racial bias in munis and how that affects pricing. Can you share some of that? And what I thought was also interesting is how that's has Breckinridge, after this sort of stable income stream, thinking about racial equity in munis.
Yeah, absolutely. So this is research that Erica Small, who's now a member of our research team, she completed when she was a PhD student at Duke University. And she did this in conjunction with other members of our research team. But basically, she found that the racial composition of a community, so the percent of a community that is Black, explains a statistically significant and meaningful portion of municipal credit spreads. I have a bunch of notes here, but to keep it focused, basically what the research found was that a hypothetical community that is 100% Black, its population, versus one that it's 0% Black population, would pay on average 19 additional basis points, or 0.19% in debt interest costs. So she and the other researchers calculated that, assuming $4 trillion in US dollar outstanding municipal debt, this would equate to approximately $900 million in additional interest costs that Black communities are paying. And I apologize for my voice, but and she also found that there was no pricing influence for climate risk. She was looking at climate risk as well as racial equity considerations. So that the combined findings indicate a systemic mispricing of risk in the municipal bond market where race impacts the cost of capital, but climate does not. And that's certainly very troubling. We wanted to also point out that this is one study. The municipal market is very fragmented and varied, and price discovery can be challenging because a lot of bonds don't always trade actively. So it's hard to make all conclusions based on this one study, and we would want more research to happen to continue to look at this, so-called Black tax. But we do find it very troubling, and it's something we do think about.
Maybe Kimberlee and Lourdes jump in as well. And what does all this suggest to you of work that still needs to be done? There's a call for better data, maybe better credit scoring mechanisms.
Maybe if I could put Rob on the spot for just a second. So Rob, when you say that you'd like to see kind of more research, more data to follow up on kind of the two studies which have been, kind of widely circulated, what would that look like? Because I mean, certainly, one of the things that I like about being kind of an investor inside of philanthropy is that, that those are the kind of things that we can help, bring to the market. So what would that look like?
That's a great question. I think additional research, possibly across different sectors within the municipal market, maybe, and we kind of touched on this earlier, but this was looking at communities, Black communities, maybe looking at what the pricing is like for different sectors within those communities. I think just kind of being able to parse out the market a bit more. I think we've talked about Erica's research, definitely a lot internally, and just want to be wary to make conclusions off of one or two studies. I guess that's the point. But yeah, parsing out the market and looking at kind of more specific aspects of the market to see if that same variability is there.
Thank you for that.
I think the points that I'll add to that is really admire Erica's research, and I think this is troubling, particularly in a rising interest rate environment when we think about the importance of bond markets and what the cost could mean over time. But two things, I think it also elevates the importance of considering credit enhancement, particularly some of the lesser discussed credit enhancement vehicles that exist within states, like state intercept programs and others that often focus on like school districts or really distressed communities, and why we're not seeing more correction or corrective activity coming from considering that element. But then also, it also makes the case for considering why are we not offering the opportunity for a discount where issuers are doing more, particularly not just with the use of proceeds, but also at the jurisdictional level from the way that they're governing themselves and that the way that they're actually prioritizing racial equity risk. Because I think it gets back to Erica's question, and maybe it's needing a wider lens in how we think about issuers and their activities when we ask these questions.
Let's open it up to other folks on the call. David Woods at Harvard got called out. David, if you're here, Eric Glass, I think was signed up. There's a bunch of you that are way more expert in muni bonds than certainly than I am. So let's jump in and air it out. David, go ahead.
I have a question for Tim and a question for Rob. And for Tim, I'm interested, like, what is the channel? So you have increased investor demand. You're happy with.
Sorry, Tim had to jump off, but I think
we did. Shoot.
But say your question anyway.
It was such a good question. Well, I'm just interested, like, what happens? And Lourdes and I have talked a lot about this. How do you translate that? The theory of change is that institutional investors will signal a demand for something social, and it'll get back to the issuers, and the underlying projects will change over time. So I was interested to hear, what happens to the next round because of this investor interest. And this kind of same question from a different angle for Rob is sort of so ESG issues aren't like a uniform bucket and investors kind of signal the interest of what they want. How do you all change what you're able to get at or what you're able to ask for, from what you're underwriting because of investor interest? Like, how do you channel a specific interest in racial equity or a specific interest in inequality? How does that become part of the broader information environment that you're looking at? Can investors provide you cover, I guess is the more cynical way to.
Yeah, we do, and we actively talk with municipal issuers about ESG issues. This year we've talked with a number of different issuers, cities, airports, about their sustainability initiatives and practices. And part of these conversations is to communicate to them that, first to say we have your back because we really appreciate the sustainability ESG efforts that you're doing, and we as an investor care about them. But then we also do communicate that our clients are increasingly asking for sustainable investment options. So I guess that's part of the role that we play, and we can certainly do more of it. But it's just having these active dialogues with issuers saying that we care and our clients care too.
There was one nuance, maybe not such a nuance, and again, Tim left, but I think the social bond that they issued in New York was taxable, and they at the same time did a bunch of other, another issue that was non-taxable. Lourdes, maybe you can just educate me at least of, you know, why make that, why some bonds get categorized one way and others the other way.
Sure. So it could be any number of reasons, including primarily that you are foregoing tax exemption because there's some aspect of the deal that doesn't qualify. And it could be either what you're financing, or it could be several other rules that apply, many of which are too bespoke to go into in this webinar, but it's all tied to the tax code of 1986 and how it applies to municipal bonds and classifies who gets the subsidy and for what purposes. But one of the advantages actually of having a taxable deal is that often it's more attractive to international investors who are not focused on the tax preference, and it actually attracts a wider audience that could lead to oversubscription, even though you're in what are called sort of taxable equivalent yield land, you know, where the deal is going to be more expensive because obviously you are foregoing that government subsidy. So it probably centered on what New York had actually authorized. Often there could be rules around reimbursement, for example, that trigger also the loss of the subsidy.
But also, if you're a say a foundation, for example, and you're not paying taxes, and you could buy a taxable bond and not worry about it. Is that right?
Yeah, different investors who again don't need that tax preference can look at that deal and see a higher yield and see value because their portfolio has different needs. The same, you know, if we were talking about tax credit bonds, for example, or zero coupon securities, you say, well, what investor would want no interest? You know, it depends on obviously investor expectations on their earnings and portfolio expectations.
I guess I'm asking a little bit of whether the taxable bonds prove the case for the tax exempt market, or whether they're sort of end up, maybe this is a Rob question, whether they end up in different sort of allocations from investors' point of view.
They do end up in different allocations. Yeah. Excuse me, because we offer tax exempt municipal bond portfolios for individuals or trusts or others. And we also offer taxable bond portfolios. So for institutions and foundations and endowments who are not taxable. And, you know, based on the supply of the market, we will invest in green social sustainability bonds. If it's a tax exempt municipal bond, it'll go with the tax exempt clients. Or if it's taxable, it'll go to our taxable clients. So having the variety of issuance certainly helps us. And what we would say is we would love more supply, lots more supply of this types of issuance, because we constantly get asked why we don't have a dedicated green social sustainability bond strategy. People like the impactful nature, as we've been talking about, of these bonds, the reporting that goes along with it. We could do even additional really nice reporting for clients if we could build a portfolio just of these securities, but the supply is not there. So that's a little bit of a tangent, but having taxable, tax exempt definitely benefits us and the different clients that we manage.
I don't know if there's other questions. I always have more
David,
questions. So.
I wanted to bring up Caitlin McLean from Milken Institute, who data came up earlier as an obstacle here is better data. And they just put out a report integrating ESG data to improve risk management and municipal resilience. Caitlin, are you available?
Yeah. Thanks, Dennis. Appreciate it.
Okay.
Good to see Lourdes, of course. Thanks for the plug. My colleague Dan Carroll has been working closely with Lourdes, and good to see so many of familiar faces and name cubes on the Zoom. But I mean, I think that one of the things that I really like about this conversation is how much there has been a shift, as Lourdes was saying, kind of a paradigm shift away from just focusing on use of proceeds to really focusing on the issuer. We've been working with the state of California for about 6 or 7 years now around a responsible issuer program to have, kind of the resources needed and the technical assistance needed for issuers to aggregate better data to really prove, kind of how they are integrating ESG factors into their capital planning, as Lourdes was saying earlier, kind of getting that in earlier and earlier, and then, kind of making that easier easier for them to go to market when they are ready, because they have already been amassing this data and analyzing this data. And I think one of the interesting things that we found, and I think someone in the chat was mentioning health data, is that, you know, there is this challenge of interconnectivity between agencies. So it's fine if you're, you know, the city of New York, but if you're a school district, and you're trying to think about not only your educational attainment and, you know, kind of metrics that are, of course, important to you as a school district, but also your climate impact, but also the housing around you. That isn't necessarily data that your agency has at its fingertips. And if you're trying to be, as that school district, a responsible issuer, but you have no control over not only the data, the climate data, let's say, but also the actions that are being taken by the community, not just you as a school district, you know, there are challenges there. So would love to hear maybe from Kimberlee or Lourdes, kind of where you guys are seeing some of the biggest kind of asks from issuers around kind of technical assistance, especially as it relates to aggregating that data, because we've heard just kind of getting that data exists, you know, in a large part. It's just that maybe they don't necessarily have access to it. So would love to hear your guys' thoughts on that too.
I'm going to let Lourdes respond to that, but ask her also just to kind of tee up before we hit the top of the hour, just kind of the invitation for folks to kind of comment and provide input to the framework, which is going to be kind of released for comment. But Lourdes, maybe you just want to talk with folks about both Caitlin's question and the opportunity to provide input.
Sure. And Caitlin, great question, I think, and Dan has been a wonderful partner, and your entire team at Milken in this process. And one of the biggest learnings that actually came from both the channel of market stakeholders that Dan convened and also from issuers is the data challenge, particularly where we had some small to mid-sized cities who said, I'm the only person in this office and I have a 0.5 person. And if we have to add a label to a deal that's social, green, sustainable, or even centering racial equity, we don't have the capacity to report without additional resources. So we're thinking of supporting the resource gap by really providing beyond guidance and technical assistance, but other resources that we'll announce later this year. In the same vein and very similarly to what you're experiencing with California, it's a very real challenge where it's not non-compliance, but I think it's a market where the limitations around scale are often overlooked. Oh, and as Kimberlee said, tomorrow at National League of Cities City Summit in Missouri, we will be releasing, and this will be available on our website Friday, the process for stakeholders who want to join us in the work, particularly through a feedback phase. You know, we've done a lot of deep learning, but we want to start sharing the framework with individuals who are committed to this work and either partners in the effort or issuers and other stakeholders, so that when we can release the framework in final form in January, it'll be informed by as many market stakeholders and voices as possible. So please stay tuned and reach out to me if you'd like to be a part of that process. I'll put my contact in the chat.
It's the top of the hour, so obviously if you have to leave, you know, feel free. No shame in that. But if you can stay, we'll keep going for another 15 minutes. And this often is the sort of more free-form part of the discussion. And folks who are the hardcore can hang around. Just to maybe kick that off, I'll say no conversation around ESG these days can go on without discussing the ESG backlash. And I imagine that some cities in some states may not be able really under current, you know, new rules being put to actually do ESG issues or even engage with underwriters who might do ESG. Is that right, Lourdes?
So in Texas, for example, and several other states, there are restrictions on underwriters who can actually participate in the state because of their policies on ESG. We have not seen any particular examples beyond that where local control is restricted and you're prevented as a municipality to exercise your full right to borrow and center an ESG value. But that is, you know, everything is changing day to day. It could even have changed today. But it's certainly an environment that is interesting and important to watch as we think about this work.
Are there other folks who want to pop up? I don't know, Isaac. Maybe you can let folks unmute themselves now, right? So
anyone who wants to unmute themselves can unmute themselves.
Can now unmute themselves. We did that just to be clear, because we did have this some problems with sort of Zoom bombing early in earlier calls, which we're trying to. And if you got Zoom bombed in earlier calls, I certainly apologize, but we're trying to keep tabs on that now. But I don't know.
Go ahead,
Rob, I
Erica.
see
Hi, Erica Bryce, Kresge Foundation. Hi, Lourdes.
Oh, hi.
Lourdes has been a special advisor to our team as well. So very appreciative of her work. Rob's comment, I had to think about who said it exactly, kind of hit me. And this is something I've wondered about for some time. So we talk about Erica Small's work and the Black tax, right? It goes back to how we're looking at underwriting standards. And I'm just not talking about ESG. I'm thinking about risk in general, right? It makes me wonder, number one, what risk is being covered up? Not intentionally, but by automatically assigning certain credit standards to cities that are white-led or things like that. And then also, what high quality credit are we missing because of things like the Black tax? So I always get a little prickly when we talk about this is just in the realm of ESG, because it is ESG, but it's also hardcore finance risk. If you have this practice, is there a correlation with your success, either operating or whatever it is? I don't have an answer. I'm throwing it out there because it's something I'm thinking about a lot with the cities we serve in particular, is when these practices happen, are we saying something's less risky when it is? Or are we saying something is more risky when it's actually not, and we should financially be thinking about investing in those things? So I'll leave it there. Thank you.
Erica, I missed at the beginning who you're with. Just maybe say again.
Oh, I'm an investment officer with the Kresge Social Investment Practice.
Got it.
Thank you.
Erica, can I ask you a quick question?
Mm-hmm. Sure.
Just when you said you work with communities and cities, when they're going to issue a bond and it's being priced, and if it's a community of color, has there ever been any surprise at the the coupon or the valuation that's being offered at that time of market being higher than expected?
So from a Kresge social investment practice perspective, I can't answer that. We do support communities. We work with communities. I haven't had a direct relationship with some of our municipalities around that. So I'm actually going to look at Lourdes. I would say for our endowment team, I've heard similar kind of things as they're looking at those opportunities. I'm also a pension fund trustee here in Kansas City, Missouri. And so just kind of interacting quite a bit because everybody wants to come for the pension fund first, right? When they're trying to look at credit quality and issuances and things like that. I have felt at times because of our leadership that we have been deemed unfairly for what we are being charged on interest. So, yeah. I will say broadly, talking to some of my colleagues, I have at times found myself surprised given other factors in their tax bases and things like that, where I just thought it may be inequitable.
Erica, I mean, I think the way you frame that observation too, in the other Erica's research, to have the Black tax identified alongside of climate risk not being identified, or sorry, not being priced, like drives that point home in terms of like what risk is actually being covered up and what risk is being unfairly priced. So I appreciate that.
Thank you.
And I'll just concur. I think, as Erica mentioned, I think I have not seen one specific example, but I think it speaks to the very dynamic that Erica Small has documented in her careful research, and why it's in a highly fragmented market. It's very hard to even be able to answer that question.
I mean, one of the things that is always brought up as an example, but we haven't brought it up here, but is like, where are the revenues coming from cities and what risks may be in that? And the example that's always used is cities that rely heavily on fines and fees, which often fall disproportionately on people of color as well. Rob, is that something you guys have dug into? A little bit. But
not extensively as far. And again, it kind of goes back to lack of standardization in the reporting of revenue by cities. Some cities will show that, show a revenue breakdown, and you can calculate that 10% comes from fees or punitive fines, but there's many others that don't. It kind of gets consolidated and buried, so it's hard to determine. So we've done a little bit of research there, but but there's those limitations.
Is this something, I see some activist folks on here. I feel like this is an area you all have dug in and really done some great work on. Is anyone from activist here that would want to speak to that particular question?
There's a good line, Lourdes, I think it may be at the top of this framework about improvement in the material conditions for populations and the mitigation of material risks in jurisdictions, so that there's some actual correlation over time, at least, between improving, the community and therefore improving the credit score as well. More healthy, vibrant communities, have good tax bases, pay their bills, right?
Yes, and I think I heard possibly Chelsea McDaniel from Activist, who I agree. They've done amazing work around fines and fees, really elevating as one of the first thought leaders of the importance of that in thinking about the security for bonds, which we also encountered communities telling us was important. But I agree with you the learning around risk versus impact came from our partners at the Milken Institute and the learnings through that channel. And one of the things that we wanted to elevate is that there's a room to think about a framework that speaks to both, because we really see a relationship between the two. And that's the stance that we take around enabling measurement, and also the narrative that we want issuers to be fluent in, who are curious about this work and strengthening their practices.
Folks want to add to that? David Wood, I know you. Are you still here? Maybe he's jumped off. He had been working a lot with investors and institutional investors, I think, in particular to gauge their interest in all of this. But I think he may have had to jump. As you can see, we jumped into the deep end of municipal finance with this project. We're happy to get the education, and we're going to keep at it for at least well into next year. And we're going to rely on Lourdes and the network that she's pulled together, and all of you for guidance. So please keep your insights and deals and best practices coming to us, and we'll round it up in Muni Impact and ImpactAlpha. Anybody want to have a last?
David, just briefly, Chelsea, who must not be able to jump in, shared in the channel a Louisville example where there's ongoing Department of Justice investigations that that sort of thing isn't being priced in or reflected in their rating. And we're going to be working with activists and others to sort of lift up some of these examples. I think this is a blog post that Chelsea shared, a great set of blogs over at Activist. So we're going to try to lift some of those up as well.
Okay, I guess my deadline pressure here did surface. Cheryl, you've got your hand up.
Oh, sure.
Yeah, good afternoon. And I'm not on camera because I'm actually working with a family death right now. But I wanted to be sure to tune in today and to hear more about this work. I'm at Virginia Tech, visiting professor of practice, long-term public finance, and senior executive governmental career. In between my tours at higher education, I'm now back in higher education, and former executive director of the State Municipal Bond Bank in Virginia Resources Authority. Nice. My question at this juncture was very much related to the tax base conversation that has threaded through today's discussion, and particularly the very, very recent research that was based on the recent release of a lot of the federal housing financing agencies data that actually shows significant undervaluation of minority-owned property, which is even when controlling for all other factors such as income, etc. So when we talk about those communities that have a large minority population, we find that the tax base itself is undervalued because of the inequities in that that are very fundamental, obviously, in the real estate assessment and appraisal world, or appraisal and that market valuation. So I think that with the significant research that's been done in terms of the pricing of the municipal bonds related to higher minority populations, it's also worth looking at and considering another layer in terms of the systemic undervaluation of their tax base. In that regard, I very much follow along with Lourdes' one of Lourdes' comments. Of course, you know, I agree with all of Lourdes' comments, but one in particular with regard to looking at the management, governance. As I teach my students in financial management at the School of Public and International Affairs, the economic profile does not cast the die. And we've actually done case studies where we see that even though the economic profile would be very, very concerning and damning, if you will, that when we look at what the communities do with what they have to work with, then they actually excel. So I think the governance of NG and management, as is a factor in all credit analyses, is an important thing to look at and not let the economic profile cast the die.
That's an important point. Lourdes or Rob, do you want to add to that or come back on that?
I'll only say I'm in full agreement. I think that's one of the many issues that we think about that could impact the credit quality implications for an issuer, sort of, you know, how their tax base is being valued, the level of risk in their finances it's being perceived of, especially if it's not grounded in fact.
Yeah, I would just say Cheryl makes really excellent points. Definitely agree with what she's saying, what you're saying, Cheryl.
Thank you.
So terrific. So I mean, just to wrap it up, we've started at the top saying, you know, municipal bonds could be the original impact investments, but there's some structural obstacles and issues that have to get ironed out, which Lourdes and RWJ and many folks on this call seem to be actively working away at. So I think it's a huge and important body of work. It got lots of nuances, as you've seen on this call, and a lot to chew on here, and we're going to keep at it. We'll be back with more of these calls, as well as more coverage in ImpactAlpha. So thanks to everybody, particularly the guests, but thanks to all of you agents of impact for joining us, and we'll see you next time.
Thank you.
Thank you.
Bye-bye.
Thanks, everyone.